Hey everyone. So I know there's been a lot of noise in the markets lately, and with headlines shifting daily, news about tariffs and market volatility, it's easy to feel uncertain about what's going on. So we wanted to just take a few minutes, answer some of the biggest questions that we've been getting from clients recently, mainly what's really driving the markets right now, whether we should be worried about a recession, and what smart investors should be doing right now. As always, our focus is on keeping you informed and helping you stay on track with your long term goals. I've asked Sam Rodriguez and senior advisor Travis Floyd to join us. Travis, Sam, thanks for making the time, guys.
Of course.
I mean, of
All
course.
right. So, Sam, the markets are down almost 8.5% since they peaked back in mid February. Does this mean we're heading into a recession? What's going on?
Not really. A market pullback, even one of 10%, doesn't automatically signal a recession. Markets in the economy, while they're related, they don't always move in lockstep. And these kind of declines, they actually happen a lot more regularly than we think. On average, the S&P experiences a 5% decline almost 3 times a year. And there's usually about a 10% correction once per year. Historically, after that 10% correction, the market tends to recover within about 4 months on average. And actually, since 1980, the S&P 500 has had an average, what we call an intra-year decline of 14%, meaning that at some point during the year, the market drops by that amount. But despite all of that, 75% of those years where we've had that kind of drop, the market still ends the year positive. So what's happening right now is a combination of factors, right? People being concerned about interest rates, definitely people being concerned about recent tariffs. But if you look at the broader economic picture, we still have a strong labor market. Corporate earnings have been pretty steady and consumer spending is holding up much better than we thought. Now, recessions, they're typically going to be driven by things like rising unemployment, negative GDP growth, corporate earnings really falling very sharply. And we're not seeing those red flags yet. So market corrections, they're going to happen more frequently than recessions. And this pullback looks more like a normal market volatility rather than the start of an economic downturn.
And Travis, a lot of people heard President Trump seeming pretty unconcerned about whether we're going into a recession or not. What do we need to take away from that?
Yeah, I think it's important to remember that politicians, no matter who they are, often speak with an agenda in mind. Right now, we're in trade negotiations with a lot of countries. So you have to remember that as we're discussing some of these tariffs, what they could mean long-term, short-term, more often than not, they're going to be a short-term negotiation. So I think it's important to come back and kind of refocus on what Sam just talked about. And let's lean more into like the economic factors and some of the policy changes that we could see coming from this administration. As markets are forward looking, we react more to economic fundamentals than they ever will to political statements. So just come back and reset your stage of knowing that these are simply negotiation tactics.
So, Sam, going back to you, what should people be doing in their portfolios with everything going on?
Well, I think the best thing that investors can do is just not overreact to the short-term market swings, right? Market downturns, I know they're unsettling, but like I said earlier, they're also normal and they often create some opportunities. So I think the things people need to focus on is number one, their allocations of their portfolio. So if your portfolio was built based on you achieving your long-term goals, it really doesn't need big changes right now. But if your risk tolerance has changed, now is a good time to review that and maybe adjust it. The other thing I would say is maybe rebalance the portfolio if you need to. So these pullbacks, they can throw your asset allocation off. So rebalancing, it could make sense right now to stay on track. The other thing is look for opportunities, right? Market dips, they create chances to buy quality investments at lower prices. And this is where having a plan and sticking to it could really pay off. And of course, stay diversified, right? The best way to weather uncertainty is by not being too concentrated in any one given area. The biggest mistake investors make during times like these is really letting that short-term fear dictate their longer-term strategy, right? The market rewards patience, and those who stay invested throughout all times, they typically are going to be the ones that come out ahead.
And Travis, looking at the sector side, are there any specific areas that are poised to do really well in the current environment under Trump?
Yeah, when you look at any administration, there's always going to be certain sectors that tend to benefit more than others. The nice thing about having maybe a second round here with President Trump is we've seen this before. So we kind of know the tailwinds that we saw in his first term. And you can always kind of go back and highlight, okay, what did well from 2017 to 2020? What were things that really benefited from those policies? And energy and oil always come up as a big opportunity. Defense and aerospace tends to be a place that not just President Trump, but Republicans in general spend quite a bit of money in. Financials do better when we have lighter regulatory environment. And of course, industrials and infrastructure tend to also do better, not just when we are sending more government money in those directions to fund those projects, but we're also seeing regulations loosened from an environmental standpoint. So these are all areas that they did really well in President Trump's first term. I would expect them to do the same. And then one other area you could probably expand out would maybe be in your small capitalization companies, your US companies that are a little bit smaller than the big names you see every day. As we loosen up some of these regulatory restrictions, these are the kind of companies that will do well.
I think this would be really good for both of you to speak on, but in general, what are we doing in our portfolios for clients right now?
Well, and as Sam talked about earlier, it's important to remember that we're investing for the long-term outlook. So we don't want to have an overreaction to any kind of market volatility in the short term. I do think that these markets will level out. Like I said, a lot of this is just uncertainty. And so markets tend to be more volatile when we have uncertain conditions in the future. Remember, we're always forward looking. So there's always things that we can do in the meantime. When we have big pullbacks, sometimes that's the best time to go ahead and do some loss harvesting. So from a tax standpoint, we can be very efficient here and really help out your bigger picture. Secondly, I do think that equities are probably a place that we may lean more towards, but there is some opportunity starting to show itself in fixed income that we haven't seen in a couple years now. So where we've been primarily focused on that short to mid part of the yield curve, we could see an opportunity later on in the year where we start pushing that longevity out. There's still opportunities that we can take advantage of. We want to make sure that as we keep our long-term focus, that we're still staying nimble in the day-to-day exposures and what opportunities are provided to us.
So I'd say for clients who have cash on the sidelines that are wondering whether or not now is the time to put the money to work, I'd say be selective about it. Maybe decide how much cash you want to keep on hand in case of any kind of emergency or an even further pullback. But we're not making any broad new purchases. Right now, we're rebalancing portfolios when they drift outside of their target ranges, right, to make sure that you maintain your proper diversification. But most importantly, right now, we're going to continue to emphasize the diversified approach, especially for our retirees. If you're retired, what we're doing is strategically drawing from the more stable parts of your portfolio during this time. And what that allows you to do is that allows the growth-oriented portion of your portfolio to recover without forcing unnecessary sales at these lower prices. But again, as always, the best strategy is going to be to stay focused on your long-term goals rather than this sort of short-term noise.
Yeah, and I think, a really important takeaway for everybody watching is to keep in mind volatility is just a part of investing, right? The key is not letting your emotions drive your decisions. You got to stay focused on the long-term fundamentals, maintain diversification, and really use the downturns as opportunities that end up serving you as the investor better than just reacting headline to headline. Appreciate you guys watching. If you have any questions, please reach out to your advisor. We're more than happy to help. But until next time, thanks.